Hello, hello. Habari zenu? Okay, so we're waiting for a quorum. Habari zenu? Okay, so we're waiting for a quorum. Okay, so we're waiting for a quorum. Hello. Great. Now I can see we are four in number. Are you able to invite your colleagues so we can start in a big way? Are you able to invite your colleagues from your classes, like students who are doing triple A, double A? Please tell them to join right now. Tell them to join right now. Go back to your classes, group classes, and ask those senior ninjas, senior colleagues, in this case here, to join. Hello. Great. I can see we are four in number. Go to invite your colleagues so we can start in a way. I can now see the number is really going up. Now we are talking of 9, which is very good. It's about audit and assurance. Yeah, the number is going up, and of course, with your help, we shall be able to do great things surrounding what we call audit and assurance. And I would want to know whether I'm audible. Are you guys able to hear me from your side? Are you guys able to hear Mwalimu? Please talk to me. Are you able to hear me? Kindly mention there yes or no. Of course, it could be yes. Because from my side, I can see the signal is very strong. All right. So, the gentlemen, I don't think we shall be able to get any more. So then what I should do is to come here and display the content that I would want us to look at. All right. Now, ladies and gentlemen, I just want us to look at two things here today. I would want us to look at what we call materiality in auditing and assurance, and what we call audit risk. The moment we answer those two, then automatically we are good to go. So I will be able to go through, first of all, the risk chapter. And in this chapter, we shall learn what audit risk is, materiality, significance of the risk approach, understanding the entity and its environment, risk assessment procedures, and then we have what we call analytical procedures. So what is audit risk? Ladies and gentlemen, remember by definition, when you go outside here auditing organizations, there is a very high chance that you may end up giving what we call inappropriate audit opinion. The evidence that you have collected, in this case here, may lead you to making a wrong decision. That this is a company that, for example, was to get an advance opinion. But in this case here, because you did like what we call small sampling, there were a few issues here and there, you ended up giving a qualified opinion. So the chance that you may end up giving a wrong audit opinion is what we call the audit risk. Is what we call the audit risk. Is what we call the audit risk. All right. Then I would want to still continue sharing my screen here. Audit risk definition: the risk of issuing an inappropriate audit opinion. It has three components. We have inherent risk, we have control risk, we have detection risk. So when you talk of inherent risk, this is the risk that is really inbuilt within some balance, within some number. So that risk in this case, ladies and gentlemen, that if you read here, we are given a very good definition, ladies and gentlemen, which will enable you to understand what inherent risk is. The susceptibility of a balance to being misstated, to misstatement before consideration of controls. Before consideration of controls. Ladies and gentlemen, when you talk of inherent risk, whether there are those controls, whether you put in those controls or you don't put them in, inherent risk, if things were meant to go wrong with even all your controls, they will go wrong. They will go wrong. So when you talk of inherent risk, by definition, it is the stability of a balance to misstatement before considering controls. Examples are a client, a higher risk because a client is in a volatile industry, rapidly changing technology. We have complex what here accounting. These are very good examples, but if I were them, I would have given a very good example of inherent risk will be, for example, the COVID what year? The COVID-19. You see, it doesn't matter how big the company was. When COVID struck like this, I mean, very many companies were affected negatively, regardless of how strong the internal controls they had in place. So when you talk of inherent, it is a susceptibility. You are susceptible, all right? You are prone to the danger. Whether you put on the controls or you don't have them, if it is, there is that inherent risk. Assuming in this case, ladies and gentlemen, you're working for a bank. So a bank, of course, their tool of trade is what here is money. Regardless of how strong internal control systems you're going to put in place, there is a very high risk of money being stolen from a bank. So whenever we talk of inherent risk, ladies and gentlemen, we are looking at the exposure of those balances that you have to risk with or without controls. Without controls, without even considering controls. I mean, I should be able to say, hey, cash at the office, this is quite risky. It's quite risky. Now, ladies and gentlemen, for us to be able to understand this concept even better, I would want us to continue looking at this. If you look at these, they are talking about, in this case here, control risk. The risk that the client's controls fail to prevent and detect misstatements. So the client, if it's RCM college, we have a soldier at the gate. Even if these soldiers at times are very thorough, they may not be able to identify everything. So that risk that our internal control systems will not be able to pick issues are what in this case we are calling what? Control risk. And then now we have what we call the detection risk, of course, as an auditor, as I go there to audit. I'm so sure that, my work is to put down an opinion regarding financial statements. All right. But again, at the end of the day, I should be able to put in some safeguards to ensure that if there is any fraud going on, as an auditor, I should be able to get a notification. I should be able to know. But now there is this risk that the risk that the auditor fails to detect material what here misstatement. So whenever we talk of audit risk, ladies and gentlemen, please listen and listen to me very well. Audit risk has got three components. Audit risk has got three components. We have what we are calling inherent risk. We have what we call the controls risk, and then we have the detection risk. So whenever we talk of AR equals three of them, we have inherent risk, the risk that is really within this particular balance here. All right? Within this particular balance here, that things could go wrong regardless of how strong an entity you are. Things can go wrong. Susceptibility. All right. And then now we have, ladies and gentlemen, what we are calling the control risk, that there is a very high chance that whatever controls the company is putting in place, that they may not be able to detect, they may not be able to prevent any what here, any misstatements here, any frauds here. They could be useless. And then last, ladies and gentlemen, we have what we are calling what here, or we have what we are calling the detection risk. That now we as auditors, whatever we are putting in place, we may not also be able to detect the misstatements in the financial statements. Ladies and gentlemen, here we are told something here. So you can see here the risk that the client controls fail to prevent and detect misstatement. Examples: higher risk, old or ineffective accounting software. See, accounting software is supposed to act like a control, but if it's very old. Lack of segregation of accounting duties. All right. Lack of authorization procedures. All right. Then we have the risk that the auditor here fails to detect material misstatement, which is the detection risk, and they're giving us very good examples. Using inappropriate procedures, misinterpreting what here results. Misinterpreting results. Now, from there, we go to materiality. Now, ladies and gentlemen, when we talk of materiality, really, this is quite a crucial area in your syllabus. It's quite a crucial area in your syllabus. And I'm happy because I can see now we have 15 in number. The only problem is that, of course, most of my students are not here because you have not called your colleagues. Tell your colleagues that you are live here. So materiality, we are looking at the size. Anything in our financial statements is said to be material if it's omission. If in this case here you happen to omit it, then automatically you're going to make a wrong decision. So any balance, any item in our financial statement here, it could be like, for example, receivables. If you omit it in the financial statements, or if you put it in the financial statements, that you're going to end up making a different opinion. You're going to make a different decision, a wrong decision. Then automatically, whatever balance you're talking about here will be said to be what to be material enough. Please listen. If, for example, today I was to have, say, like 1,000,000 Kenya shillings, and then somebody in this case here comes and takes, like, say, 10 bob. So if they take 10 bob, I mean, I'll not be able to chase after anybody because 10 is immaterial. Even if, for example, that particular asset was to go for exactly 1,000,000, and I go and approach these guys, tell these guys, but I mean, I can't even trace my 10 bob. I mean, they'll easily close their eyes and give you the asset here. So that really cannot change whatever alternative those guys are there gone for. If it's a vehicle going for 1,000,000, I'm short by just 10 bob, those guys will still give you the vehicle. They can't change a decision. They can't change the alternative here. But you see, if, for example, we are lacking, say, like 200,000, that now is immaterial. Those guys will change their alternative here that they had picked. So anytime we talk about materiality, this is what we shall always be thinking about. So materiality, significance, we read first of all here. Materiality, information is material if it's omission or misstatement. If it's omission or misstatement could either individually or in aggregate influence economic decisions of users taken on the basis of the financial statements. Ladies and gentlemen, remember that these particular figures we're giving out there, they are being relied by so many stakeholders. So if we leave out something, of those financial statements, and whatever is left will then automatically influence the kind of decision that will be made by these decision makers, then automatically that item is material. Is material. So materiality, information is material if its omission or misstatement could, either individually or in aggregate, influence the economic decisions of users taken on the basis of the financial statements. So materiality is very, very important, ladies and gentlemen. All right. So in this case, your significance, financial statements which are materially misstated will not give a true and a fair view. Auditors must test all material balances. So as an auditor, when I discover that receivables are material, then I have to put in my audit procedures and really inspect and really audit the receivables figure because it is material. Now, so the most important thing in this case is to appreciate your determining materiality, the size, nature, and of course, even the timing. All right. Then we have materiality here, performance materiality, an amount set at less than materiality for the financial statements as a whole to reduce the risk that the aggregate of smaller misstatements in individual account balances or classes of transactions could exceed materiality for the financial statements as a whole. So shall be looking at this performance materiality later on when I'm looking at a practical question. But now, ladies and gentlemen, please listen. What normally happens, you'll go and set your materiality threshold, say at 1 million. You see, at 1 million, most of the things that are really below this 1 million, you'll not be able to do a lot of audit procedures on them because you'll say that those are immaterial. Normally, what happens, if for the whole organization I have a figure of 1 million, there are things that are quite sensitive, even if they'll not be able to pass the hurdle up there. There are things that are quite sensitive that during performance, when I'm now performing the audit, when I'm looking at individual items, I have to set a lower materiality level to be able to touch on sensitive items. So that lower materiality level that you put as opposed to the aggregated materiality for the whole farm is what we call performance materiality. During performance, when I'm performing now my audit procedures, I'll be able to lower my standard. When I lower my standard to be able to perform audit efficiently, then whatever materiality you set there is what we shall be calling what here? Performance materiality. So of course we'll be able to come up with this very well when we continue with our class. Ladies and gentlemen, up to now, are you able to follow? Is there somebody who is able to follow? Is there some good ninja that is able to follow? Do we have some good ninja that is able to follow? Please comment there. Please comment there. Please comment there. Please comment there. It doesn't matter whether you're watching in this case here from Facebook or from, in this case here, YouTube. So long as you are able to understand what I'm teaching, I would want you guys to give me feedback. I would want you guys to give me feedback. I would want you great students here to give me feedback. All right. All right. All right. So then, gentlemen, then we continue here. So we are told here, assessing materiality is a matter of professional judgment and is not a mechanical exercise. Each company must be considered with reference to its unique circumstances and the informational needs of the users of the financial statements. In the exam, balances will be material if they exceed 0.5% of revenue, 5% of PBT, 1% of total assets. So, ladies and gentlemen, this is something that you must always have it in your mind. Something that you must always have it in your mind. Whenever you are assessing for materiality, we have the concept of a half or 0.5% of the revenue. 0.5% of what year of the revenue. And then we have in this case, ladies and gentlemen, the concept of what year? The concept of 5% of profit before tax. And then we have in this case here 1% of total assets. Now, when we do this thing practically, when you do this thing practically in audit, normally what we'll do is to set like performance materiality for the income statement items. So for the income statement items, I'll be able to pick any of the two. Remember, it's about professional judgment. So you either take 0.5% of the revenue, I get like say 2 million, 0.5% of the total revenue, I get 2 million. Then I'll be able to also try 5% of profit before tax, I get 3 million. So then I'll be able to assess if this particular audit is quite risky, then it'll be good for me to lower. I go for a lower materiality level for me to be able to test many balances, because the higher the materiality level, that would mean what here that I do not test many things. I don't test many things. I don't get to test so many things. So that concept, this one, as you go to your exam, this is popular. It is 0.5% of the total revenue. It is 5% in this case here of the profit before tax. Those two will guide me in setting especially the performance materiality for the income statement items. And then, of course, we have 1% of the total assets. 1% of the total assets. 1% of the total assets. All right, ladies and gentlemen, what else are we told here? Misstatement, a difference between a reported financial statement item and the amount, classification, presentation, or disclosure that is required for the item to be in accordance with the applicable financial reporting framework. Misstatements can arise from errors or what here? Fraud. So whenever we talk of misstatement, ladies and gentlemen, what do we mean by this misstatement? This misstatement, we are saying that you have a figure in your financial statements, maybe 10 million. But the real figure on the ground is supposed to be 12. You see, 12 and 10 gives me what here? Gives me an error of 12, of 2, I mean, an error of 2. Misstatement also could arise because of contradictions. Contradictions between like what we have under what we call management reporting, management discussions and analysis, the management commentaries. These guys could be commenting things that are quite opposite to deceive the whole republic. So if that then happens, ladies and gentlemen, we shall be able to talk of what we call misstatement. Misstatement. So materiality should be reassessed during the audit in response to further information or risk arising. So then we have in this case here definitions of sampling risk. Let me see how big this is. Let me see how big this is. Not very big. Not very big, not very big. I should be able to cover this pretty fast because I'm so sure most of you must be quite tired. So we are told here sampling risk arises from the possibility that the auditor's conclusion, based on what? A sample. That he took a smaller sample, for example, based on a sample, may be different from the conclusion reached if the entire population was subjected to the same audit procedures. So, ladies and gentlemen, remember, we shall always be working with sampling. But at times I can take a sample. I've picked 5 students instead of working with 100 students. You see, 100 is the entire population. 5 is smaller. So 5 in this case is the sample. So this sample, when I analyze the sample, whatever results I get, they should be able to mirror what we call the census. They should be able to mirror what we call the results of the population. But you see, ladies and gentlemen, if I make a conclusion based on a sample, and this conclusion based on a sample is different from the conclusion that I would have reached if the entire population was subjected to the same audit procedure, then that risk, we call it a sample risk. So it means that your sample is defective. Now, sampling risk is the risk that the auditor reaches an inappropriate opinion despite a representative sample being chosen. That, ladies and gentlemen, in this case here, the auditor has been able to take what they are calling a representative sample. This could be quite a huge sample, for example. All right? But you still go ahead, despite the sample being quite huge, quite appropriate, but you still end up giving a wrong audit opinion. So that risk will be called non-sampling risk. That risk would be called non-sampling risk. Non-sampling risk. Now, ladies and gentlemen, from there, I would want us to move straight away to this one here. We move straight away to this one here. Significance of the risk approach. Remember, you've got many risks, or rather many approaches to audit. And one of these risks here, or rather one of these methods, is what we call the risk approach. Inherent risk and controlled risk cannot be directly influenced by the auditor. Remember, the auditor's work in this case here basically may not be able to capture whatever errors, whatever misstatements that there are in the financial statements. All right, that is what we call the detection risk. We are not able to detect. That's what out of the three risks, our risk is detection risk alone. Otherwise, inherent risk, this is the risk that is born, BORNE, that is well within that particular balance itself. From there, now we go a shell outside here. We are supposed to be having a shell which is supposed to protect those balances from being misstated. So in this case here, if that shell is called control. If the control is not really working, then that is called control risk. The auditor can, however, manipulate detection risk. If they assess that the inherent and control risk are high, if they are very high, i.e. increased risk of material misstatement, they can lower detection risk through the following means. Increasing substantive testing, increasing sample sizes, using more experienced OTR staff, increased levels of supervision, increasing review procedures. Now, ladies and gentlemen, this is something I'm so sure that you guys have done. You see, if I would want this detection risk to really be very minimized, if I would want it to be very minimal, I have to put in a lot of resources as an auditor. I must bring in experienced staff. I must bring in great software, etc. So if I go to the farm, remember you've just said here that audit risk equals inherent risk times control risk, CR, times detection risk. So if I go, ladies and gentlemen, and I get that the organization is very well organized, the controls are really, really working. So meaning that the control risk is low, and also in this case here, the inherent risk is low. If both of them are low, then as an auditor, I would want to minimize also my audit cost for my clients here. I don't want to really put in so much for them, they will have issues. All right. So if I realize that the control system is working very good, inherent risks are also very low, then what do? I must always want to take the detection risk high by doing less. I'll be able to sample less. So detection risk will be high so that they balance. But if the two are high there, then myself, I'm quite disadvantaged because now I have to take my detection risk low. Now, please listen and listen and listen to me very well. I would want to repeat this. But unfortunately, my students are not giving me feedback, so I can't really be able to know where we are exactly at, where they are following, and because now they're not able to share at all, now I think we shall be able to stop. They'll be able to share here. So we're being told that the auditor can inherent risk and controlled risk cannot be directly influenced by the auditor. The auditor can, however, manipulate detection risk. If the auditor assesses inherent and controlled risk to be very high, i.e. increased risk of material misstatement, they can lower detection risk because now detection risk has to go down. That danger has to go down. Now we have to discover more things ourselves. That danger has to go down. They can lower the detection risk through the following means: increasing substantive testing, increasing sample review procedures. By performing a more thorough audit, there is a less risk that the auditor fails to detect material misstatement. By performing a more thorough audit, there is a less risk that the auditor fails to detect material misstatement. So, ladies and gentlemen, I just wanted to do something small. After all, I don't think you guys are really following. I just wanted to do something small like that, and it's my belief that if we do like this every day till your exams, then you will be able to really benefit out of these discussions. So can you kindly do me a favor? I'm working so hard to see whether I can reach 14,000 subscribers as soon as possible, most probably before the end of this particular month. Are you able to, ladies and gentlemen, are you able to kindly get out of your way and please look for the subscription button. Please subscribe, and then of course ring the bell for you to be able to get this kind of what here notifications. Otherwise, it has been a great pleasure hosting you tonight. I'm looking forward to meeting you guys tomorrow during the day. I'll be able to send something during the day, and then of course, bye bye. Bye, and thank you.